Good afternoon, everyone. Thanks a lot for allowing me this opportunity to speak. So, my name is Richard Lum, as Colette said. I'm one of the founders of Victory Hill. I think before I start the presentation, just by way of an origin story, a very compressed origin story, the key principles behind the manager Victory Hill came from the energy investing and financing industry. We've done this for a fair amount of time between us, and really towards the end of our financial career in the city, in banking specifically, we identified actually the transition occurring with a lot of our large integrated energy clients, and we knew actually that the transition would be pushed not so much by the large industrial groups, but certainly by the middle market developers. And we wanted to participate and enable middle market developers really to get access to capital in order to enable the transition. And that's really where we came together. And actually, I'm quite pleased to say we're this Friday due to celebrate the third anniversary of the launch of GSEO on the stock exchange. So yay to us on that basis. Right, so I'm going to touch on 3 points. I'm going to take you through fundamentally why it is we believe the transition is a very interesting opportunity set for us as managers, and in particular for capital seeking a very interesting differentiated return and yield visibility, and how it is that we can bring that together through the background that we have as a team, and really answering Colette's homework question to us, what is the impact on the higher rate environment on our strategy, certainly? And just beginning with the first one, I guess we want to take a step back and understand the transition in totality. It's a global phenomenon, and actually it's fair to summarize that GSEO is the only strategy, as far as we're aware, that is globally diversified. And the reason for that is we believe in order to achieve the transition, in order to make an impact within the transition, you need to look beyond just the UK and beyond just one technology as well. We see the transition fundamentally as something akin to a second industrial revolution. So therefore, it will create dislocation in energy markets that accept the transition, that embark on that journey. And it's really that dislocation that we find, that market dislocation that we find very interesting as investors, because we believe that's where it affords us an opportunity through our investments to get a differentiated return. And I can take you through really examples of that as we go through the presentation itself. How are we able to mine and understand these market dislocations by virtue of our backgrounds, actually, of having transacted, between us, certainly my principal, Eduardo, and I, on the investment side, over $200 billion of investments in the energy sector throughout our careers across the whole energy value chain. And we're not looking only from the context of just renewables. We are renewables focused, but we're more energy transition focused, meaning conventional technologies as well that enable the energy transition to net zero. That's really important to us. We've transacted across borders, across different other energy markets, and we're able to interact with them, have connectivity with them to originate new, really interesting opportunities, but also to relativize different markets and see where that opportunity set is, see where that dislocation is. It's not so important for us to really connect with a single technology to enable the transition. We don't think, respect to James, but certainly we don't think solar by itself is going to solve, the problems in terms of enabling the energy transition, nor will wind by itself. It's a combination of different technologies, and it's really the underlying markets that we understand and where we see the opportunities that we will pair with different technologies that is, that we believe will provide us with that better return. What's the impact in the higher rate environment? Well, to answer that question, we have by design constructed a portfolio in GSEO that has very, very minimal debt. In fact, probably the lowest level of any debt in any of the listed trusts, about 2.2% at fund level that exists in one single project. There is no structural debt at the fund level itself. So we are immune to those types of considerations, and also our revenue streams from the projects gives us high level of visibility, yet at the same time they are index linked to inflation, and they track inflation as well. These are the two key really determinants that enable us to achieve and protect ourselves in this environment. I'll go into that in a bit in the following slides. So this is the story as we currently see it. We are both a yield play and also a growth play as well, because of the value that we see in these market dislocations. We're targeting total return of 10% in the portfolio, progressive dividend in fiscal year 23 of 5.52%. That's due to increase as we continue to build out our portfolio and get much more construction assets into operations. It's fair to note, actually, and apologies for the 1.3 times dividend coverage as of June. I think it's slightly lower, but thereabouts in September. But that's on the basis of 54% of the portfolio only operating as it currently stands. So there is a big momentum behind NAV growth, but also the ability to achieve greater dividend multiples as we get more of our assets online during the course of 2024 and beyond as well. It's a real growth story, and we're very much active managers ourselves, so we like to get involved in different assets, try to re-commercialize them, get better commercial terms out of their revenue streams, or indeed invest more capital into where we see value. Just to answer a couple of the questions that Colette asked us, just to frame the discussion points. What if rates remain higher for longer? Well, all our programs currently in the GSEO portfolio are fully funded. We have cash on the balance sheet in order to be able to fund these projects. The remainder of that, we said 54% of it is in operations. The remainder to get them online. Okay, so we have the resources to be able to get a lot of these projects online and producing cash flow. And the target return really isn't reliant on us going out and seeking additional third-party capital. We have a very skeptical view of actually incurring debt right at the outset as we construct our projects. We want debt only to be involved in our projects during operations if we feel it's there is a capital optimization angle to it. The reason that we are so stringent about this is we believe we have the ability to get the maximum revenue profile for our projects by mining those dislocations I mentioned earlier, those opportunities to get a differentiated return. The higher rates, impacts of higher rates, interest rates in GSEO portfolio, clearly minimal because we are not reliant on leverage. As I mentioned before, there's zero leverage at the company level, about 2.2% if you were to aggregate that single project right up to the fund level. And we see really this as being something that will be a minimal effect on us as we move forward as well. And in terms of the team's ability to perform in this type of environment, well, one thing I should note as well, as I mentioned earlier, it is a globally diversified strategy here. So we're not only looking at the effects of inflation, higher interest rates within the context of the UK. We are looking to see what the effects are on different other markets. We're currently exposed to the US, to Brazil, to Australia. They have different market fundamentals there that we've sought to achieve differentiated returns from, with the minimal use of leverage in those particular transactions. The types of revenue contracts, and it's about 90% of our portfolio are contracted on long-term revenue contracts there, are inflation linked, so therefore we provide greater also protection. Two, there's about a 10% of the portfolio where we have consciously decided to take exposure to the merchant market. That's in Australia, where we believe there is a very interesting play here to access higher power prices through the usage of battery storage together with solar, hybridize the solar production, so that you can time shift that very cheap or free solar resource and dispatch it at the peak prices that you would achieve at the peak times in the mornings and in the evenings as well. So you want to be naturally exposed to that type of dynamic there. Now, just something to note in terms of the way we approach our investments, really. We want to make an impact from a sustainability perspective and also get a differentiated return. And that's really reflective in the way that we look at new investments wherever they are in the world. We start off by understanding whether those investments conform with our understanding of the energy transition and the role that the UN Sustainable Development Goals have in terms of enabling this. So there are 6 UN SDGs that we assess new projects to ensure that they fit through the lens of one of those 6 SDGs. 3 of them actually relate to the impact of investment in sustainable energy and the consequential impact that would have on communities and societies globally. The further 3, 8, 9, and 17 are much more generic and relate to the impact of capital investment in infrastructure and the positive effect that could have on society as well. And it's only when potential projects get through one of these lenses that we will take it further in terms of consideration. And we've characterized the energy transition with 4 phenomena that we see, external manifestations of the transition. The first one clearly being addressing climate change. That's a very important piece of the energy transition, working on climate mitigation through technology. Secondly, providing access to clean and affordable energy through communities and industries throughout the world is also an important mission of the energy transition. Thirdly, the less energy you use to achieve what you want to in society and in industry, the more climate mitigation you would have. We call that energy efficiency. And fourthly, we look for projects where there is, in markets, energy markets that are liberalized, that allow you to trade the supply and demand of energy and allow capital to come in an unregulated way, because that capital will help upgrade your infrastructure to achieve the energy transition. And it's only when we've gone through these types of pathways in terms of characterizing the sustainability impact value that we then look at the investment itself from a commercial perspective. And here's the thing, when we look at investments from a commercial perspective, they have to meet 3 criteria. The first criteria, and I've alluded to it earlier, is the investment must meet or seek to solve for a structural demand gap in the energy market that we're interacting with. Within the context of the UK, for example, my view is, is there a structural gap in relation to the amount of capital that is required to enable renewable projects? My thoughts are there isn't. There's clearly a significant amount of capital to enable renewable projects within the UK. That's part of the success story. The real structural gap within the UK is because of the success of the renewables and renewable build-out and penetration in the UK power mix. When the wind doesn't blow or the sun doesn't shine, then you get stuck in terms of the supply of power into the grid. And as we've seen, certainly in the winter periods that we've experienced so far, the grid operator still has to call on conventional and more pollutive sources of power, including coal-fired power plants that was actually supplying up to about 3.6% of the overall power mix over the last couple of months in order to make up that difference. That is not sustainable. So therefore, within the context of the UK, we think in order to achieve a sustainable energy system, we should be investing in some form of flexible power to intervene where there is insufficient solar resource or wind resource to power the grid. You come in with a more dependable source of power, which in our case is gas-fired power plants. However, we mitigate that because we capture the exhaust that comes out through the production of power using gas. We capture the CO2, we scrub it into what we call food-grade CO2, purified food-grade CO2, and we commercialize it further through selling it into the food and beverage industry, where there is a structural shortage of clean, purified food-grade CO2 to help us manufacture essential goods such as beer. Okay, so that gives you a little bit of an example as how we see the structural gap. And in doing so, we're able to monetize 2 strips of revenues, one from the power sales, where we intervene in the market, get very good pricing through that, and secondly, through entering into a long-term revenue contract with an industrial gases offtake for the purified food-grade CO2. Secondly, we've met the structural gap. We want to have the ability to actually better optimize the asset that we either acquire or the asset that we build. We want to have the optionality within it to tinker around to get better commercial terms out of that asset as it progresses in its life, or indeed invest more in that asset to get a better return as well. One very good example of where we pretty much can't do that is if we were to invest in a long-term renewable asset in a regulated market where you're basically plugging into some form of subsidy over the long term. Then that's all about just ensuring that you have the best cost of capital to be able to realize the project in the first instance, but the idea of optimizing it further is pretty limited. And thirdly, we have to make a positive impact as it relates to the project itself, a positive environmental and social impact, because of course we're sustainability investors. Sustainability is at the heart, as I mentioned, of what we do. We use the UN SDGs as the framework for us. We're SFD 9, Article 9 compliant. And all our investments, generally speaking, are focused on ensuring a positive outcome over the long term. And actually, in terms of assessing the ESG value of the investments we make, you may have heard this term called carbon myopia. There's a lot of reporting about this currently. I mean, investors, generally speaking, I'm not saying anybody in the room, may be too focused on actually the carbon impact of the asset itself when it generates and produces its product, and they don't look at, generally speaking, the whole life cycle of how that asset got to where it did and what's going to happen to it thereafter. We look at each asset across the life cycle. And we take a great deal of effort in terms of looking just beyond the carbon impact into what is the social impact of that asset itself. How is it making lives better? How is it meeting some of the other UN SDGs in addition to climate mitigation, of course? This gives you a little bit of an example of, the distribution of our portfolio. As I mentioned before, we're very unique in terms of having a globally diversified portfolio. We have assets currently in the UK, in the US, Brazil, and in Australia at the moment, but we're building that out as we're currently speaking. It's important for us to address markets where we believe there is a structural gap, but where we can also make a sustainability impact. Top right here, you'll see about 54% of the assets, the portfolio at the moment is currently operational. There is a big upside here as we bring in further assets operational during the course of the year. And that's going to have a very positive impact in terms of dividend coverage ratios, but also the NAV POP. Now, I want to give you an example as to how we see, very quickly, how we see sustainability. It's not only in relation to renewable generation. This is a very good example. This is the first asset that we actually acquired right out the box after IPO in 2022. 2021. It's a fuel storage terminal in Texas. Okay, why are we doing this? Because we want to make a positive sustainability impact as it relates to the Mexican fuels value chain in Mexico. Not sure if you realize this, they still use conventional fuels. They're unlikely to go to electric vehicles anytime soon. And we wanted to basically extricate all of those dirty fuel products they have in the country that is manufactured by out-of-date refineries. Those tend to go up north across the border into the US, where there are state-of-the-art refineries that can further refine this product, take out the dirty fuel, the sulfur content out of it, and then reship down the cleaner fuels into Mexico. In order to do that, they have to park those fuels, whether they're dirty fuels going up north or cleaner fuels going down south, at a location in Brownsville, the port of Brownsville. It's on the border between Texas and Mexico. We felt investment in this would stimulate that further, and indeed one of our key clients in this facility is a national energy company of Mexico that has this mission of recycling that dirtier fuels. They're one of our biggest clients in the port. We acquired this asset. Its current invested amount to date was $104 million. We're currently trading thereabouts at about a 14% target net IRR at the moment. There's very minimal leverage in this, about 10% leverage at the moment. But this is an example of a story where we've invested in the broader transition to net zero. It's important nonetheless. We've invested further capital into it. We've further commercialized it by renegotiating contracts around the asset. And we've achieved, really, from a point in time when the net IRR, when we initially acquired it, was about 10%. It's now trading about 14% without leverage. And here's an example I mentioned earlier as to how it is that we're tackling the structural demand gap in the UK. It's currently under construction, but it's a flexible power plant in the UK that dispatches energy on demand using natural gas. But we actually capture the exhaust that comes out of it. It's a very unique program. There's no other facility like it in the UK currently. Facilities where they sequester the exhaust CO2 gets put in the ground. That's very marginally economic at the moment. There's a lot of modelling that's required around that and a lot of government support. This requires zero subsidy, zero government support. The reason for that is the technology that is used is highly efficient. So it's very interesting to large energy companies who want to use these types of assets to trade into that flexibility market in the UK. We've achieved a 15-year power purchase agreement with one of Europe's largest utilities. And under that, we actually are able to fix not the price of power, but the margin, meaning the differential between the price of power you receive and the cost of fuel, natural gas you pay away. We're able to fix it up to 5 years for each specific winter or summer seasons. On the CO2 side of things, we've entered into a 15-year sale agreement for the CO2 with Boozer, one of the largest industrial gases off-takers in Europe, under which we have a fixed price with a escalator for inflation that has not been capped. So again, inflation, just to point out again, is a friend of this portfolio. We're very much geared towards ensuring that flexibility and keeping up with any increase in inflation. Now, in conclusion, and before I take some questions, just a couple of points to note again. Minimal leverage in the portfolio, so we are immunized essentially from the current environment that we're in at the moment. This high cash generative nature of the portfolio itself, that's what we're about. We're about seeking those dislocations and getting the best possible private contractual revenue arrangements in place without the need of subsidy. We are post-subsidy as a strategy. But 90% of the revenues come under long-term contracts that are inflation-linked. There is a positive NAV uplift that is expected in the portfolio. As I mentioned before, 54% operational. That will increase as we get construction assets into operations over the course of the next 12 months or so. And there is active management of these assets to invest further or re-commercialize contracts to increase the value in them as well. We have a pretty highly experienced management team, both from the investment side of things and also from the operational side of things. The unique model that we have is we tie up with operators, these middle market developers who need capital. We tie up with them under operating agreements and under joint venture agreements where they provide the commercial and the technical nous to specific assets. They identify the unique opportunities in that particular energy market. We provide the capital and we work together to ensure that the asset actually provides value to shareholders in the fund. We also provide, of course, sector-leading target returns at 10% unlevered, which I think we can all agree is pretty juicy. So that's it in conclusion in terms of GSEO. Be very